The Rebel Capitalist Show.
Let's go ahead and transition over to some bullet points you have on your website. But let's just go over those bullet points. So the first thing is, over the past 120 years, sovereign debt levels as high as advanced economies' debts currently are or have been resolved in three ways. So we were talking about that. You got default, restructuring, inflation, or hyperinflation. One thing that I'd like you to maybe expand on there, and I think I originally got this chart from you. So thank you very much. And I use it constantly. And that is the chart of the German mark relative to marks backed by gold, and therefore basically the mark versus gold from 1920 to roughly 1922. That the mark actually appreciated in value against gold, and I believe the dollar as well, from roughly, there's about a year and a half time span from 1920 to roughly 1922. And that was, and basically a year and a half later, the mark is toilet paper.
Right. Oh yeah, no, that chart, yeah, it shows basically the immense volatility.
Yeah, like a year, but a year that preceded that.
Yep.
That preceded that massive hyperinflation in 1923. The mark actually appreciated in value just slightly against gold. So it shows you how quickly things can change if you have all of that excess money printing, let's say, that's been happening for years and years and years, in this case since 1914. And so I think the point there, the takeaway, is that a lot of people see the dollar really not moving right now in the DXY, but they don't realize that if the seeds have been sown, that can be extremely explosive, that inflation.
Yeah, I think that's right. And that chart, all credit for that goes to Dan Oliver at Mermicant Capital. It's his chart. He wrote a letter about that, or that included that. So I want to make sure to give him full credit for that, because it's a great chart. And these 6 charts we put on our website in January of this year. So coming into the year, and they've actually they've aged pretty well. I was looking at them the other day, and yeah, this chart shows the behavior of the German mark against gold during the German hyperinflation in the early 20s. And it's, to your point, it's really 2 things that really grab me. Number one is if you held gold on a levered basis, you lost all your money 4 or 5 different times, because like
that was during the 1923 period.
Yeah, the mark appreciated. There were times when the politicians came out and said, okay, we're going to act to stabilize the mark, and it went the other way. For a period of time. Now, it's amazing how much that chart looks like the chart of Bitcoin in dollars, or any of these cryptos in dollars, or it's people always say, oh, crypto's so volatile. Crypto's just crypto. Bitcoin's, it's a fixed supply. Real estate, we're seeing real estate rise at the fastest rate in 40 years, home prices. And it's one of these things where generals always fight the last war, right? The old saying. Everyone's waiting for the shoe to drop on real estate. But the thing that's grabbed me that people just aren't, I think, appreciating enough is in 05, 06, what was driving that was a supply of private credit. That was bank credit, that was subprime credit, that was the asset-backed market. There was private credit, private capital at risk backing that. What we're seeing drive prices now is the U.S. governments and Western sovereign governments, and even Asia, China, more broadly, this sovereign bubble, they need to keep the sovereign debt price elevated, rates low, as a matter of national security, and they can never run out of capital. Like the aha moment I think most investors have not hit is what if this is the home price bubble you never sell? What if, because again, if home prices crash again like they did in 05, you're assuming the supply of capital has dried up. But the supply of capital,
and potentially rates have gone up. Yeah, but they can't raise rates.
They can't raise rates, and it's the supply of capital is infinite because it's coming from a printing press. It's not coming from a private source that is at risk of losing any money. And
especially if we go to central bank digital currency, and the Fed starts issuing mortgages directly.
Yeah, and even from a political standpoint, I mean, you can see the shift in Washington. I mean, generals always fight the last war. These politicians in Washington are convinced that deficits don't matter. Now, in the short run, they don't. But in the long run, again, they have mattered 100% of the time for 10,000 years of recorded human history. So the amount of hubris and exceptionalism to say they don't matter for the United States now, just because they haven't mattered for the past 50 years because of how the system is structured, is extraordinary, because 50 years is a long time for you and me, but in history, it's a blink of an eye. Like, this stuff always ends the same way. So, the question is, of course, when does it end? We've gone through this process where sovereign debt it is now a matter of national security that the sovereign debt market be priced improperly, that the sovereign debt market be priced at an increasingly negative real interest rate.
Yeah, why don't you unpack that a little bit, Luke? I've followed you, and I totally get what you're saying. But for some of the viewers who might not have heard you or any of your ideas before, can you kind of unpack why that's a matter of national security?
Sure. So the easiest way to think about it is, if you're running debt to GDP at 130%, you need to get that back. Basically, you got to get that back down to a normalized level, so you can, or to a lower level, so that you can raise interest rates without choking off your own government, without choking off your own economy, because debt levels are so high. Historically, the way you do that is by having negative real interest rates. So you let inflation run a little higher than the rate of interest you're paying on the bonds, and as that happens, you have GDP growth rise, and nominal GDP growth rises, and bondholders lose some purchasing power. And after a stretch of 5 or 10 years of doing that, your debt to GDP is down to a normalized level. You can raise rates and kind of go back to it.
1940s.
The 1940s, right? So you saw U.S. debt to GDP go from 110% to 55% in 5 years, and U.S. real interest rates, in other words, the amount that it was interest rate minus inflation at the lows, were at negative 14%. So in 1 year, after I think 46 or 47, U.S. bondholders lost 14% of their purchasing power in a single year relative to inflation. That's historically how this has worked out. Now, the United States in 1946 to 47, they were the world's biggest creditor. So when you're a creditor and you run negative real, it's easier to run negative real interest rates without disrupting capital flows. And that's the other thing. So we were a massive creditor, and you had restricted capital flows. You had capital controls around the world. So capital couldn't run from this repression. It had nowhere to go. And gold was illegal for Americans to own.
Right. Good point.
So the challenge is that when you're a twin deficit nation like the U.S., if you run and you're foreign financed, when you run significantly negative real interest rates, you're basically stealing purchasing power from your foreign creditors. That's a great situation for us. It's hurting them, helping us, and we've been doing this for a long period of time, a little by little. I would equate it to when your kid has a drug habit and your kid breaks into the neighbor's house and steals their jewelry, hawks it. Like, that's great, because you know what? My wealth, my standard of living is going up. The kid can have his drug habit. It doesn't matter. He's stealing from the neighbors. That's making the neighbor poor. It's not making me poor. That's the U.S. runs twin deficits, and foreigners finance those twin deficits at a negative real rate situation. If you do what we've been increasingly doing since 3Q14, when foreign central banks stopped growing their holdings of treasuries on net, and then after 3Q18, when the global private sector stopped buying as much, now you have a twin deficit that has gotten much bigger and that is increasingly being financed by the domestic sector. And so this is like your kid having a drug habit and stealing your shit and selling it. Now your kid's drug habit's making you poorer. And so what negative real rates does to an economy when the government's deficits are being financed by the domestic private sector amounts to a tax increase. They're basically increasing taxes on U.S. bondholders to pay for the government's deficits. And so the economy shrinks over time, the government grows over time, and you end up with what is effectively a state-run. The government's a massive percent of GDP. And guess what we're seeing? We're seeing exactly that happen.
And if the economy shrinks, the tax receipts go down. Therefore, they can't afford to pay for the military. Therefore, that's how it's a matter of security, national security.
They can't pay that. They can't pay. I mean, we're already seeing social unrest at the highest levels in 50 years in the last 2 years. Can you imagine what would happen if they start cutting entitlements?
Right.
It can't happen. So that is the challenge. And so it is why we're different now than we were after World War II. And oh, by the way, there's everybody loves the dollar as a weapon. Free flow of capital. We will just, we'll raise rates and we'll suck all that capital back over here, right? We'll dollar milkshake the world. Brent's right. We could do that. The challenge is it's a two-edged sword. And because we deployed that weapon too much, the capital's all here. And one of the conditions to the post-$71, you have to have a free flow of capital. And if you start financially repressing it, remember we talked about earlier on, Japan has 60 to 70% positive net international investment position as a percent of GDP. You start screwing the Japanese out of the real wealth, they'll go, you know what, forget it. We're going to bring it home and we're going to go redeploy it into where we're getting paid a higher rate. And so what does that look like? It looks like Chinese bond market getting $120 billion of inflows last year. Now, that might not have been the right thing to do, given some of what we're seeing with Evergrande, some of these other things. But the issue is that there is actually a free flow of capital. That you can only financially repress that capital for so far before it escapes, unless you want to put capital controls in, and that's fine. You put capital controls in though, and the dollar's status post 71 is over. That's a change in structure. So it's the Fed's really kind of trapped in this box. The U.S. government's really kind of trapped in this box that they created. It was a great system, and it's sort of gone too far. The success of the system has sown the seeds of its own destruction.
Yeah.